Hi everyone, welcome back to InvestED. If you're at a restaurant and your waiter comes over to take your drink order, their first question probably isn't going to be whether you want a drink out of a bottle or a glass. Now, there are differences, of course. I personally prefer to drink out of a glass, but the reason that they don't start with that question is because what's most important is not the vessel you're using to drink out of, but the drink itself. In investing, drinks like Sprite or Coke Zero, they're the equivalent of investment portfolios, and ETFs and mutual funds, they're the equivalent of cans and bottles. While the decision to invest in an ETF or mutual fund is relevant, what's more important is the investment portfolio that's within. Now, the ETF container, so to speak, has predominantly throughout history been used to invest in low-cost or index tracking investment strategies. And mutual funds for a long time were used predominantly to invest in actively managed higher cost portfolios. And for that reason, the container, that ETF or mutual fund, started to become synonymous with the investment strategy within. But today, that's not really the case. The lines are totally blurred, and much like soft drinks being available in cans or bottles or fountain drinks, frankly, most investment strategies are available in either ETF or mutual fund. So mutual fund, ETF, they're vessels that hold investment portfolios. So what exactly are the differences between the two? Well, let's take a look. First difference is that ETFs trade throughout the day. You can buy an ETF at 10 a.m. and sell it at 2 p.m. Mutual funds, you can buy and sell throughout the day, or at least you place your order, but all trades are executed at the end of the day, so there's no intraday trading. For long-term investors, this doesn't really matter, but if you're a very short-term tactical trader, perhaps it might. The second difference is that there still are some strategies that are only available in ETF or only available in mutual fund. That doesn't include many low-cost index strategies, because many nowadays you can get in mutual fund, not just ETF. But there is still more selection of index strategies within ETFs. You can get active alpha-generating strategies in ETF as well, but there still is more selection in mutual funds. So while there's tons of overlap, it's not 100% overlap, so there still may be a specific investment strategy that you want to invest in that's only available in mutual fund or only available in ETF. And then lastly, there may be some differences in costs. One cost for ETFs, for instance, is a bid-ask spread. This is typically a very small cost if it's a popular ETF, but can be a bit more if it's a smaller, more niche ETF. This bid-ask spread is a price that you pay for transacting on an exchange, and an ETF is an exchange-traded fund. There is no such cost for a mutual fund, but there may be other costs depending on how you're buying investments. There may be commissions if you're self-directing your investments. So the differences in costs are often inconsequential, but worth mentioning. So overall, there are differences between ETFs and mutual funds, but as you can see, they are far more similar than different. They are both used to invest in a portfolio of securities, and many strategies are available in both ETF and mutual fund. We'll talk about the underlying strategies in a future video, but with that, thank you for watching.